online for 2020 performance review. We start by really looking at the year 2020 and what it was. And as all of us are aware, 2020 started like no other year with COVID-19 being detected in the region for the first time in March. So it's a year since. And the last global health pandemic occurred back in 1919. And it appears the world had lost memory. And as the world has really struggled to cope with a COVID-20 environment. When we look back the year, we saw that COVID-2019 quickly injected a health crisis, COVID-19 pandemic, which quickly disrupted global supply chains, disrupted manufacturing, disrupted distribution because of COVID management protocols and government containment measures. And as a result, quickly, the health pandemic escalated into an economic crisis with now the famous great lockdown of economic activities. And as a result of disruption of economic activities, our livelihoods were heavily disrupted. Jobs were lost, livelihoods were lost, and as a result, the world ended up with a humanitarian crisis. A humanitarian crisis with poverty increasing substantially, the world losing ground on things like vaccination programs, not being able to stick to those. We saw a lot of people lose their jobs and livelihoods as a result. And so a lot of investments were lost. Hunger became a major challenge to the world. And essentially, the stress converted the environment to one of human misery, fear and uncertainty. So that is what year 2020 was as an operating environment for the bank. Given that strained operating environment, the equity group chose to focus then on its core purpose, the essence for which it exists. And equity exists to transform lives, give dignity, and expand opportunities for wealth creation that supports livelihood. And so the environment dictated that we rise to the challenge for what we are called to really give dignity in an environment that is that challenging, give opportunity for livelihoods by supporting wealth creation. And more importantly, doing our very best, using our resources to protect lives and livelihoods. And so when we look back, we drifted from intermediation, from numbers, from balance sheets, from deposits, from loans, to supporting our host communities. And of course, the first host community was our staff and our customers. And the issue was how to protect our staff and to protect our customers. And the mechanism involved one, rolling out a program of ensuring awareness, knowledge among the staff on what COVID is and what COVID is not, and to really discuss the coping mechanisms and the protocols that could protect staff if well practiced. And that made us trigger on a very skilled expansion of our Equity Afia franchise, which then took responsibility for knowledge and overseeing the protocols within our establishments at the branch level and converting staff to trainers of customers so that the entire 15 million customer base and 10,000 staff could be safe. That involved providing opportunities for 50% of the staff to work from home, dividing the bank staff into two, 50 work from the office while the rest stay at home, just to try and mitigate contamination among the staff and customer base. And to encourage customers to focus on compliance with health protocols, we waived charges on mobile platforms to encourage customers to migrate from brick and mortar infrastructure that provides service in form of ATMs and branches and merchants and agents, and to direct them and to incentivize them to use their mobile phone and devices. And in the process, we ended up by waiving up to 1.2 billion shillings of fees that would have been levied there. With 45% of the customers projected to be in sectors that were adversely affected by COVID management and containment measures by government that resorted to lockdown of some sectors, we encouraged customers within those sectors that constituted 45% of our customer base to apply for accommodation. This accommodation included waiver of loan accommodation fee, and that ended up a waiver of another 1.2 billion shillings, what customers would have paid to have their loans adjusted in terms of repayment, giving them repayment breaks of both principal and interest for the period that their sectors could be affected. We then focused on lead processing and understanding customers through relationship management to deeply understand their request. And we ended up with 32% of all the loan book being accommodated. And that accommodation meant giving them repayment breaks for up to 3 years, depending on the severity of impact on specific sectors. And that has, we are glad, provided relief to our customers, then to focus on supporting their families, supporting their employees, and deploying the resources and cash flows that they had to retool, to repurpose their businesses so that they could adapt to the changing environment. This helped to keep the rights of the economy on, helped to keep economic activities running, and those economic activities supporting lives and livelihoods. We then, as a group, mobilized up to 1.7 billion shillings, and together with our partners, MasterCard Foundation, we ensured that we made a contribution of 1.4 billion shillings to COVID management programs, either of providing PPEs to doctors who were handling COVID cases, providing testing kits like in Rwanda, and so forth. And that program has continued, and we still have resources to maintain the 68 dedicated hospitals with PPEs for the next 1 year. We also then took our Wings to Fly and Elimu scholars, thought about bridging for them the digital divide. We provided them with solar-powered radios, lamps with mobile charging capabilities so that they could be able to maintain contact with their teachers and follow online school curriculum and programs, while at the same time, we provided them with a monthly stipend to ensure they covered the essentials of life, and that deprivation was kept at bay so as the kids could not get detracted. We then mobilized more of the community through education, ensuring that our branches became training ground for our customers, to ensure that they became aware and confident about and lower their uncertainty and fear of COVID, and believe and develop faith in protocols as the best mechanisms of protecting themselves. That went a long way to institutionalize the purpose and essence of this bank, the vision and mission of this bank, and to build trust through a very integrated shared prosperity program with the communities. The second program was then to protect the bank, and we did this by ensuring that capital buffers were maintained, and we maintained the capital buffers by withdrawing the 2019 declared dividend of 9.5 billion shillings and supplementing that with a tier 2 capital raising, hence increasing the capital base of the bank by 20.5 billion shillings to ensure the group was fortified and mitigate the operational risk that could be associated with COVID. We also enhanced our risk mitigation capabilities, particularly within the credit book, and we obtained partial credit guarantees to support the credit book and enhanced that by making an additional provision of 26.6 billion shillings to deal with the uncertainties within the loan book and to create buffers for certainty of quality of the balance sheet and to fortify the balance sheet. To fortify and enhance liquidity buffers and mitigate the risk of accommodated client loans that spelled repayment moratoriums of up to 3 years, the group obtained foreign direct funding amounting to $350 million or nearly 40 billion shillings, raising the liquidity level of the group by 7 percentage points up to 59. And these took care of the cash flows that were lost through loan accommodation characterized by long repayment breaks. We also identified an opportunity for organic growth and focused particularly on Kenya and Uganda. And we are glad to report that that process of very strong focus to deepen our presence in the two markets resulted in significant growth during the period. And then we seized an opportunity of an acquisition and merger in DLC by acquiring BCDC, the second largest bank in Democratic Republic of Congo. And during the same year, we were able to migrate, merge, and rebrand the new acquisition with our existing Equity Bank subsidiary in DLC. We also saw a huge opportunity of a major shift in customer behavior driven by erosion of trust in mechanisms of access to financial services, and particularly in an effort to comply with the health protocols that the ministries of health had recommended. And we saw an accelerated adoption of technologies, appended on theory of purpose first, community engagement, the imagining the business model, and the repositioning ourselves. And I'm glad that the management was able to convert the COVID crisis into a good crisis and use it as a tailwind of adoption of our digital banking platform. And I'm glad to observe that for the first time in our history, we got online delivery channels processing 67% of the entire value of transactions, for the first time exceeding 50% of the total volume in terms of value of transactions. And in terms of number of transactions, up to 98% of all transactions happened on online platform, particularly the mobile platform. And lastly, the board decided to significantly strengthen its social brand, enhancing the online banking, focusing on mobile technologies, and integrating itself with the desires of the community and the direction the community had taken in terms of technology adoption. So that defines not just the environment, but the deliberate and intentional steps that the group took to contain and to manage the COVID environment and to adjust and repurpose the business in a rapidly changing environment. And in summary, the bank and generally the group adopted a twin strategic approach of being very defensive of the communities and society in which it operated in, defending the staff and its customers, defending the business model and practice, but also adopted an offensive approach by its leader adopting the phrase, "We should never waste a good crisis." And the process adopted a very offensive strategy to take up opportunities that the market offered. And essentially, that ended up with a very significant organic growth in Kenya, increasing the market share by nearly 2 percentage points, and a steep growth and of market share in Uganda, while at the same time taking advantage of a merger acquisition opportunity in DLC to propel the group from being in position 4 to position 2 in the DLC market. When we put these efforts and the environment in which we are operating, would confidently say the group was able to adapt to the COVID environment and wither the disruption of COVID-19 to register a 51% expansion of the balance sheet, growing up to 1,015,000,000,000 shillings, up from 674 billion, a 51% growth during the COVID year. The growth, as we said, was both organic and also through mergers and acquisition. And the growth was led by an expansion of the deposit base by 53%, increasing the group's customer deposit base to 741 billion shillings, up from 483 billion shillings. And that, of course, needed us to improve the mix. And we complemented that with long-term debt financing that grew by 71% to 97 billion shillings from 57 billion shillings, so that we could have a proper breaded funding portfolio suitable for the lending needs and investment opportunities in the marketplace. The expanded balance sheet, the increased loan book by 30% and deposit base by 53% necessitated a capital leverage, because that is capital consuming growth. And we increased our shareholders' funds by 24% from 112 billion shillings to 139 billion shillings, ranking us among the most capitalized businesses and balance sheets in the region. The deployment of the additional 51% growth of balance sheet, driven by 53% growth in deposit, necessitates us to really support the economies in which we operate, ensure economic activities continue to happen so that livelihoods could continue to be supported. And I'm glad that we were able to weather the fear and uncertainty of a COVID environment to grow the loan book by 30% to 478 billion shillings, up from 366 billion shillings. Of course, we were not able to deploy, because of timing, the entire deposit growth, and our cash and cash equivalents grew by 186% to 247 billion shillings from just 86 billion shillings, positioning us well with raw material for deployment in 2021. We were able to increase investment in government securities by 26% to 217 billion shillings, up from 172 billion shillings. Of course, that transformed balance sheet had a significant impact on our P&L, or profit and loss. And we saw the top line of interest income growing by 23%, rising the total net interest income to 55 billion shillings, up from 45 billion shillings, driven primarily by the 30% growth rate in the loan book and the 26% growth in investment in government securities. I think the greatest growth we recorded was in non-funded income, where we recorded a 27% growth in non-funded income to reach 38 billion shillings from 30 billion shillings, principally driven by 41% growth in total to contribute. The non-funded income that grew by 27% contributed 41% of the entire total income of the group. Of this non-funded income, which contributed 41% of the entire income, the biggest drivers were Forex trading income, which grew by 77% to 6.2 billion shillings, up from 3.5 billion shillings the previous year. And this Forex trading was driven by diaspora remittances, which grew significantly and contributed 32% of the entire Forex revenue that was traded by our treasury department. And this, of course, was as a result of diaspora growth in volume, resulting into commissions growing by 76% to 1.5 billion, up from 900 million shillings, with the Forex trading increasing 51% from 863 billion, or up to 863 billion, up from 571 billion shillings. So we saw a complementarity between Forex trading and diaspora remittances, suggesting that it's internally generated Forex that was being traded and suggesting a sustainable stream of income. That was significantly complemented by trade finance, which also weighed in. Having looked at the income, when we came to the operating cost, we saw the operating cost grow by 67% to 71 billion shillings, up from 42.5 billion shillings, principally driven by a 496% growth in gross loan provision of 26.6 billion Kenya shillings, up from 5.3 billion shillings the previous year, increasing our cost of risk to 6.1%, up from 1.3 the previous year. And these higher loan loss provision enhanced the group's non-performing loan book coverage to 89%, in line with the bank's policy of mitigating the uncertainty of the COVID environment. As part of the group's commitment to support lives and livelihoods, keep the rights of the economies on and avoid massive disruption of economic activities, the group accommodated 171 billion of loans for customers whose payment capacity was adversely affected by COVID. And it is this 171 billion shillings made the group to be cautious and increase the provision up by 26.6 billion shillings. This 171 billion shillings represented 32% of the entire loan book of 530 billion. So while the group offered customers in the adversely affected sectors up to 45% accommodation, the actual request from the customers ended up being 32% of the entire loan book. And that demonstrates the commitment of our customers to keep observing their obligations. As at that 1st December, 40 billion shillings of the structured loans had resumed repayments, and as a result was categorized and back as normalized loans. We did a deep dive on the 171 billion through customer relationship management, customer visits, analysis of performance, and doubts were cast on future viability and quality of 9 billion shillings of loans, prompting and downgrade of the said loans to doubtful level, that is IFRS 9 stage 3 NPLs. And this prompted us then to increase the portfolio. Part of the 26.6 billion, 9 billion was for this book that was accommodated but determined to be of doubtful quality. And as a result, that increased our NPLs overall in the group for up to 11%, up from 9% the previous year and 10% as at the end of the third quarter. That reclassification of the 9 billion then meant that of the accommodated books, we removed 49 billion shillings, and we were only left with 23%. From 32, only 23% of the accommodated book is now under management, which is equivalent to only 11% of the entire balance sheet of the group. So I would say most of the management's time was spent in managing the 171 billion shillings, ensuring that quality is monitored closely, customers' relationships are enhanced, and as a result, we are fairly confident about the remaining loan book. The group's cost-income ratio improved during a very difficult year to 48.5% from 51% the previous year, principally driven by improvement on cost of funding that shaved off 10 basis points, enhancement of government yields that enhanced on the entire portfolio by 60 basis points, while and that happened despite the realization of capital gains of up to 3 billion shillings, up from 1.1 billion the previous year, and 177% growth of mark-to-market gains that rose to 7.4 billion shillings at the end of the year, up from 3.4 billion shillings. Yields on loans declined from 12.6 to 12.4, principally due to suspended interest on the 11% loan book, and also a change on the loan mix in terms of local and foreign currency as a result of the US dollar denominated balance sheet of the acquired BCDC in Congo, and also because of the 186% growth in cash and cash equivalent. The profit after tax contribution from the business outside Kenya grew to 28%, up from 18%. The group continued to transform itself into a low-cost operating business model and maintained the interest capping regime that existed before the beginning of the year, just to mitigate the risk of default, and focused more on enabling self-service capabilities to customers, transforming the banking experience from the place you go to what you do on devices, specifically the mobile phone. Digitization enabled 98% of the group transaction to happen outside the bank premises, while 87% of all transactions happened on the mobile platform. And we see increasingly the brick and mortar infrastructure is losing traction from our customers. And for the first time, through our digitization program, we saw the less than half of the transaction value, accounting for only 37% happening in the branches and 72.6% happening outside our own infrastructure. And as a result, moving on to a variable cost infrastructure. And that's truly given. When we quantify the type of social investment within communities, the biggest program being the scholarship program, agricultural transformation, small and micro business capacity building through financial and entrepreneurship training. We recognize that we have spent up to 51 billion shillings, equivalent to $464 million in delivering these community programs. The most intense program that we focused on this year was Young Africa Works, a partnership between us and MasterCard Foundation, targeting to create 5 million jobs by funding micro and small enterprises to the tune of $4.2 billion in loan and $700 million in capacity building. I'm glad to recognize that we were able to train 141,000 entrepreneurs and access them during the COVID year, 57.5 billion shillings, creating 380,000 jobs. And that on a COVID year gives us confidence that in 5 years, we will have breached the target of 5 million jobs within the communities that we look upon. Given the growth of the balance sheet, we realize the 51% growth rate of balance sheet was capital consuming. The deposit growth of 53% and loan growth of 30% are all capital weighted items, and the enlarged operations of a balance sheet more than $1 trillion shillings require capital risk weighting. And as a result, the board was not able to recommend payment of dividend and felt the internally generated funds would continue to provide the capital leverage required by deposits and the capital risk weighting required by the growing loan book and operations of a massive organization. When we looked into the future, we were very confident that the group had repurposed itself, it had retooled itself, and ensured that it was completely integrated with the host communities. It spoke to the changing demographics and technology requirements of the environment, adoption of technologies. And we felt the group ended the year very, very well positioned to rebuild on a 1 trillion shillings balance sheet, enjoy the economies of scale, is well equipped with raw material amounting to nearly $500 billion shillings of liquid assets, which could easily be deployed in lending opportunities. And the bank will then continue with its twin strategy of being offensive and defensive at the same time, and feels it is very well positioned, particularly by the 89.4% NPL coverage, to normalize the credit risk to the long-term cycle of 1.7% credit risk, and well positioned to enjoy the economies of scale and look forward to reduced cost-income ratio. The bank feels very well prepared in the sense that the model that it has developed has been tested intensely in a very challenging environment and overperformed our wildest expectations. And we came out with a conclusion that it's an agile business model that is able to respond quickly to the environment and the challenges of our dynamically changing environment. The organizational culture, which is people-centric and performance-driven, again, was tested and proven. We saw the scalability of technology and digital-enabled business, allowing the economies of scale and a self-service platform, allowing us to be able to take a 51% expansion within a year. We recognize that the growing regional presence with a large customer base gives us economies of scale, that reducing our unit cost and significantly bringing extensive efficiencies. The staff complement was heavily tested, and we realized it's deeply committed to the group's purpose and core values, engaged, and speaks to resilience and maintain the track record of speedy execution. A diverse and knowledgeable, experienced and exposed and innovative executive team has demonstrated differentiated leadership capabilities by developing unique capabilities of balancing social and economic value creation and doing well while doing good, while effectively managing inherent risk. We also observed a leadership team that is entrepreneurial and with a mindset of innovation and startup business, providing solutions and creativity. And lastly, our greatest strength came out as an engaged board, committed to the highest governance practices, courageous to exercise effective governance oversight, bold enough to push the limits of innovation and creativity, and that dare to walk untrodden paths, aware of the inherent risk. And lastly is a supportive shareholding with a long-term view of value creation and the essence of a shared prosperity with host communities while preserving the environment. This gives us confidence to really encourage shareholders to have a positive outlook of their investment and all stakeholders of our continued commitment to the purpose for which the group exists. I want to thank you most sincerely for the opportunity to present to you this morning. We'll be releasing a press release this morning, and we would recommend that that press release is best read in conjunction with the investors' briefing for 2020 performance, which is downloadable from our website. We thank you most sincerely for being with us this morning. Thank you very much.
Thank you, James. Thank you, James. We'll now invite our investors or members of the press. Those who have any questions, you can post your questions on the chat, or you can raise your hand on the Zoom, and then we'll give you an opportunity to ask your question. Thank you. But so far, we haven't received any questions.
Maybe as Alex, we wait for questions. Maybe I will ask our head of corporate reporting, Mary, maybe if there's anything that needed emphasis, maybe this is a good opportunity to brief the investors. Mary.
Thank you, James. I think overall very strong results. I think the one thing investors were truly worried about was the COVID environment that we were operating, how our book was going to hold up in that environment. And very, very strongly, SMEs have shown resilience in this environment. They have shown that they can repurpose themselves. They can rejig their business models to work with what they have. So with 171 billion accommodation, that's about 32% of the book. 40 billion of those have come back to repaying terms, and they are repaying as per contractual terms. That's a 24% of that book that is back on the books, performing well. They have been able to adjust themselves to the environment. And yes, we do acknowledge 9 billion of those, we did see an issue with the viability of the business, and we did take a proactive approach to downgrade those loans, take them into NPL stage 3 and begin a recovery process with those customers. So for those loans that are still ongoing, because we acknowledge 122 billion still remains under moratorium, we are watching those very closely. The monitoring framework that we've put in place as management continues. It is strong. We are talking to these customers every week, every month, making sure that whatever covenants that we've given them are being adhered to, whatever processes that they need to ensure resilience are still being carried out, to ensure that once their moratorium expires, they are ready to come onto the book and remain performing. So a very, very strong performance, even from that COVID accommodated book in the year 2020. And we have the same positive outlook in 2021, where with our continued very, very strong relationship management, this book will come back onto repaying terms with a very small risk of it going into NPL. And the group has shown a massive capacity to be able to accommodate that. With achieving 89% NPL coverage, we're able to have a very positive growth outlook with this book still being managed.
Thank you very much, Madam Tele. We have a question from David in Danger, and the question is, kindly share details of the Bancassurance business. I'm glad, David, to let you know that our equity insurance agency held up despite the challenges in the marketplace. It performed almost to the same level like last year. And I'm also glad to say in the third quarter of last year, fourth quarter, we were able to obtain the final no objection from the Insurance Regulatory Authority to establish a life insurance company. And we were working now details so as to get the license. We wait maybe for other questions. Maybe I will ask our Chief Commercial Officer maybe to shed a little bit of light more on the impressive growth of 51% of balance sheet, driven by 53% customer base, customer deposits, and maybe also his experience of growing loan book by 30% during a COVID year. Polycarp.
Sorry, thank you very much, James. And a real pleasure to meet everybody this morning. I think what we've had this morning from the group CEO is that 2020 was a most productive year in terms of results, working from home, facing a pandemic that affected the core target of our market. The business model of equity focuses on the consumer and the micro, small, medium enterprise. And last year, the growth we have seen in deposit is driven by their belief in the brand as a safe haven for their deposits and for their transactions. And you can see that reflected in the number of the contribution of non-funded income to total income. And we also see that in the big gush of growth in deposits. And this is born of primarily two things: the connection of that base of customers to the mission of the bank, which is to transform lives and livelihoods. The purpose really came to life because over the years, you see a unique customer behavior in the banking industry. Customers save in one bank, transact in another, and borrow from another. And we saw in a COVID year, the fusion of those three things come together at Equity Bank, especially in our core markets of Kenya and Uganda and indeed DRC. The other point we would like to make is that the conservative stance of the bank in buffering capital and an expanded appetite to continue lending is what really drove the asset growth. We have two core products focusing on women and young people. Our consumer book, for instance, in our core market of Kenya, grew by a very big factor. At our businessmen, what we call micro and small, we saw a growth of close to 56% growth, driven by an expanded appetite, especially through digital channels, online and on the mobile. And we saw character-based lending, cash flow-based lending through group lending with Pamoja Banking, what we call our Pamoja Banking product, and working capital finance for fast-moving consumer goods also grow by a whooping 36% growth. I'm now talking about sub-sectoral levels. So it's a real adoration of the brand and the service by the market in a COVID year, and truly also reflects very strong relationship management. More than anything else, I think underlying the result and reflecting that people are saving with us and transacting with us and borrowing from us is a Forex income growth of 60%. We were the bank most selected by business people to trade in Forex, which reflects trust. We were a bank that was very trusted for trade finance, which is everyday relevance. Equity became relevant every day. We were selected by customers. They chose us to remit money from, as people send subsistence envelopes from abroad, they chose Equity. And in terms of online acquiring, people also chose Equity. And it's been, therefore, a very pleasant year, and a year that proved that our people can be productive, in a very difficult year, and in a year when our customers had the most difficult thing. I think, James, in closing, so that I can hand back to you, the loan accommodation that we gave to our customers from day one and agreeing to accommodate them for 1 year, 2 years, up to 3 years, especially sectors like tourism, education, really proved to the market that we care, and they rewarded us. And we saw that reward in them choosing us as a safe haven. And we continue to release a stimulus to them by continuing to lend to them. Thank you very much for now.
Thank you very much, Polycarp. That has given us an opportunity to receive 5 questions. The first question from Lama Yang. Given the significant macroeconomic uncertainty in the next 24 months, how is the bank reassessing its dividend payout policy in 2021 and 2022? The same question comes in from Kefa Moirori, who is asked, is the group consideration of extension of loans restructures? Sorry, I think it's the second question on dividend, sorry, is from Franklin. Kefa will come to your question. And Franklin asks, has the bank elected to pay dividends for 2020 full year? And if so, how will this be structured given central bank's view that the bank should freeze dividend payouts due to COVID-19? Let me try and answer this question. It is true that the central bank has engaged banks, and all banks have been doing stringent stress testing on capitals. And the central bank has opted that it will approve any dividend and bonuses payouts before management or board would propose. For us, while the uncertainty of the macroeconomic environment is a huge consideration, we feel we have ridden the challenge of uncertainty well. The banking model have worked extremely well. The market has picked us as a safe, secure harbor, and that explains the growth of deposit base by 53%. We have seen continued uptake of loans that have gone up by 30%. And if you look at the top line of Equity Bank, that is profit before provisions, the profit has grown by 30%. But management, as Lama has suggested, a very significant uncertain macroeconomic environment, and an accommodation of 171 billion prompted us to be prudent and conservative in recognizing that risk, and increased our cost of risk from 1.3 to 6.1, increasing our provisions by 26.6 billion shillings. And as a result, we feel with a coverage of 89%, we are well positioned. But having said that, the capital requirement for the bank is coming from that growth of loan book, because its loan book growth is capital weighted. It's coming from the 53% growth in deposits, because deposits are leveraged on capital, and the operations of a trillion shilling balance sheet significantly increase the capital weighting on operations. And as a result, given the momentum that we have built, the board felt it prudent to take advantage and ensure the bank remains very well capitalized, and opted to retain the internally generated funds, because as Lama said, it's very uncertain period to be talking of capital raising. And so being bullish and optimistic that either the organic growth that we have observed in Kenya, which has increased our market share by 2 percentage points, or the rapid growth we have seen in Uganda, we believe that will continue into the future, and we need to fortify our capital base. But having said that, we see the ability of the group 2021 to generate sufficient, given that capital base is strong, we see ourselves bouncing back through 2021 with a very strong profit position that would enable us to continue to observe our capital payment dividend of paying 40% of available for distribution going forward. The second question, and I will ask maybe Mary to weigh on this, Mary Ntele, is about Kefa Muirori is asking we be projecting the profit after tax slide. If Alex, you could get that slide. And then from that, the second question, could you please shed light on tax movements, Mary? Kishan Popat would like to see on that slide, which Muirori is interested from group consideration of extending loans, structures beyond the CBK granted window. And then Kefa also asked, what is the loan classification currency, currently at the CBK classification, normal, watch, etc. And also IFRS 9, stage 1, 2, and 3. And if you can also help Kishan, what is the coverage on those stages or classifications? Mary.
Thank you, James. I'll begin with the question on tax. Why the significant decrease in the tax movement in the year 2020? The two things. So one, in March of 2020, the government issued some measures that would help cushion the economy and cushion enterprises from the COVID crisis that ensued since. And they enacted a tax rate of 25%, down from the 30% that we've been operating on previously. This therefore had an impact of reducing the tax expense that we had in the year 2020. Of course, January to March still had an enacted rate of 30, but from then to December, we have been using 25%, giving us a reduction. Secondly, the provisions that we've taken up in the year of 26.6 billion, this gives us a significant uptake in our deferred tax asset. So when the deferred tax asset goes up, we therefore have a tax credit as well that comes into the profit and loss. So the net effect of that is you see a significant reduction in our tax expense in 2020. But this, of course, goes back to the 30% in 2021. So that explains the tax movement. On the normal and watch classifications, James, just a clarification, was that for the COVID book or the total book? Okay. So total book, what is seated in stage 1 is 393 billion. What is seated in stage 2 is 78 billion. And stage 3 is 58 billion. In terms of CBK speak, in terms of the classification, that wording that is used by the Central Bank of Kenya, what is normal is stage 1, which is the 393 billion. What is watch is stage 2, which is that 78 billion. And what is non-performing, which is substandard, doubtful, and loss, that is 58 billion. In terms of provisions against each of those classifications, in stage 1, we have a 4.4 billion provision, giving a coverage of 1.1%. In stage 2, we have a 13 billion provision, giving us a coverage of 17%. And in stage 3, we have a provision of 34.9 billion, giving us a coverage of 60%.
Mary, if you don't mind, you could also talk about the 171 billion, just for further clarification.
Okay. On the 171 billion in terms of how it is classified, 171 billion was the global number that we accommodated. This is the total number in the year 2021, and we did that accommodation between March and May of 2020. Of that book, at the time of accommodation, that book was entirely performing, i.e. was either seated in stage 1 or normal or stage 2 or watch. Since then, as of December 2020, 9 billion of that has been downgraded into stage 3, i.e. non-performing, as a result of our monitoring framework and review the businesses that we accommodated. We assessed that the viability was in question because of some subjective matters that we had put in place. For example, if there was a significant reduction in business activity as of December 2020, we made a call to then downgrade these loans into non-performing, i.e. the moratoriums were still ongoing, but because of our review and our assessment of that business, it was the prudent thing to do to downgrade them. Of the 40 billion that have resumed repayment, these are seated in the performing book. They are back, they are repaying per their contractual terms and are therefore seated in the performing book. The 122 billion is still seated in the performing book, split about 70% stage 1, 30% stage 2. This is again depending on the classification that was existing at the point of rescheduling those loans.
Thank you very much, Mary. I think we have dealt with the first questions of David, Indenje, Franklin, Kishan, Kefa, and Lama. We now have another 5 questions from Eric Musau, Rama again, David Indenje again, and Anthony Mwithiga. Let's start with Anthony Mwithiga's question. Kindly expound on the intentions to set up a venture capital fund to drive the bank's involvement in the fintech innovation and startup space. And that question has something to do also with what David Indeje has asked. What is the future of Equity Bank's brick and mortar branches based on the just announced results? And let me start with David. David believes banking is beyond transactions. Banking is about relationships. Banking will always require brick and mortar, and particularly as you go to advisory, relationship management, cross-selling, and of course, the capacity building. So we'll always have branches to have, but we are very excited that the market has moved on and removed transactions from the branches. So the branches of the future will not be transactional oriented like the branches of the past, but there will be branches that helps to build the relationship between the customer and the bank. They will help in advisory for complex transactions. They will help more in having the activities and having a physical presence on the ground. For instance, most of the transactions have gone to merchants, others have gone to agents, and others have gone online. It is important to have agents and merchants on a branch. When we come to SMEs and large corporates, and we hope that our customers will continue to migrate. We have been deeply impressed by them migrating from micro to small, to medium, to large enterprises, and some into corporate. That journey requires us to interact and to be able to work with them very, very closely. So we see branches continuing to exist, but doing a very different kind of business. But Anthony then puts the second question about the capital venture fund. As I earlier on said, we are committed together with MasterCard and Kenya government to stimulate entrepreneurship in this country to create 5 million jobs. Part of the enterprises that we expect to thrive are fintechs. We expect innovations to drive the next generation of businesses, particularly those owned by the new digital generation. We expect startups to be a big opportunity. And as a result, we have opted to focus on supporting our innovative generation to settle down. And what we have done first and foremost is to expose the APIs of the bank so that they can leverage, innovators can leverage on them on a plug and play basis. We have also felt that as those businesses grow, or there will be need for venture capital to fund them, to support them, to grow. There will be need for lawyers to help them to register their patents. There will be need for accountants and marketers to help them to grow their businesses. And that is an area that we have felt to be part of our relationship managers' responsibility to coach and mentor that incubation area, because we are casting a lot on it. We may want to support, but we want to create an environment where a cluster and an ecosystem of venture capital becomes part of our entire ecosystem. So we will not crowd out others. We want social investors. We want venture capital. We want private equity to support these bubbling ideas. And we ourselves are using our investment bank will support where we can. And our fintech capabilities will also help. Our IT platform and backbone will help just to ensure that we are able to get those businesses to thrive and to give opportunity to our young people to become local capital owners within the marketplace. The second question comes from Lama. His second, how much capital has Equity put in the credit guarantee scheme to date? As at 30th December last year, we had signed up 2 guarantee schemes. Since then, we have signed 2 more, and there is 1 more we are holding on to. I think in total, it will be $350 million. And what we hope is that once completely allocated, those guarantee programs or schemes will help us to go beyond the 100% coverage ratio on our NPLs because they cut across. But I will ask Brent, if Brent, there is anything else you would like to add on the guarantee scheme, or Mary, whoever is ready.
Yeah, maybe James, just to highlight. So when you look at Equity Group and how we've provided and mitigated the risks against potential NPLs, the way to look at how we did this is 1, through the cash provisioning reflected in the 89%, and Mary and Terry gave the breakdown across stage 1, stage 2, stage 3 in terms of the coverage within that. Bear in mind, this 89% coverage excludes collateral. So there is still the collateral that we have, but over and above the cash cover against these NPLs. Over and above the collateral against these NPLs, we also have the guarantee or the risk sharing facilities that we have that will mitigate the risks of NPLs coming through over the course of this year, next year, if there are any. So I just wanted to highlight that's how you look at how we've mitigated the risks. It's the cash cover, the collateral that banks normally have against lending, as well as the risk share guarantees that will look at prospective risks in our book. Thanks, James. I don't know, Mary, if there's anything else you wanted to add.
Very well covered. Thanks.
Thank you very much. Thank you very much, colleagues. I think, Mary, here, there is another question still from Rama. Has the bank applied for revised loan pricing model from the central bank? If so, what feedback have you gotten from the regulator? Maybe to give background, up to September 2019, the interest regime was regulated with an interest capping from Parliament of a maximum of 13. It has since then been removed. And I'm glad that the industry took time because the removal of the interest capping coincided with the COVID-19 challenge. And that has helped to ensure that borrowers during this very challenging period has not had the interest increased. Banks have maintained the same interest rate during the COVID year. But when we look at capital allocation, we realize that the investment risk profile varies from one client to the other. And with a 13% interest cap, then we are talking of a commoditized interest regime. And it's for that reason that the banking industry, with its regulator, the central bank, embarked last year on discussing a better risk-based pricing model that would allow risk to be priced. And all of us, each of the bank has been negotiating independently with the central bank based on the nature and category of its customers. And I'm happy we are on the second iteration with the central bank dialoguing because this is not about an institution, it's about a banking industry. And I'm confident that in the fullness of time, we'll be able to arrive at the right pricing risk, interest risk model or risk pricing model, because it will be necessary for us to be able to adequately allocate credit within different sectors, within different borrowers. And as the country recovers from the impact and ravages of COVID-19, it will require significant oxygen to stimulate growth. And that oxygen will be in form of credit, private sector credit availability. And as a result, that flow would be enhanced and the taps would be fully opened if risk is put into consideration. So Lama, I think in a few days, hopefully, we'll be able to find out what the final agreements between the banks and our regulator, the central bank, will be. From Eric Musau, what is your sense about the clients who were under moratorium in light of the new measures announced last Friday by the president to contain the spread of COVID-19, especially considering the new strain seen a lot more and the country seems to be in a more serious health situation compared to last year. I think, Eric, there is no denying the country is concerned. We have seen the government roll out new measures of managing and containing containment of COVID. And those measures include some quite significant lockdowns. Particularly, we see the 5 counties sort of projected in our manner of movement cessation. We don't really call it lockdown. It's the movement restriction, just to ensure that the spread of COVID doesn't overwhelm our health facilities. But as we saw with wave 1 and wave 2, if people exercise concerted efforts, the wave is broken within a period of 1 to 2 months. And I'm very optimistic that the third wave will be broken, as scientists are projecting, in between June and latest July. I believe Kenyans have become better in managing these waves. The businesses have been repurposed, like we saw with the ones that are now doing PPEs, exporting significant volumes of PPEs. We have seen businesses in agriculture thriving and contributing almost 34% of the GDP. So while we can talk of impact, it's not a generalized impact in specific sectors that are affected. And I'm sorry, particularly for the travel sector, where, for instance, flights, domestic flights are being halted, where restaurants, bars are not able to open, where evening hospitality sector is affected by the 8 p.m. curfew. But Kenyans have proven resilient. We've just seen the results of Equity Bank in a COVID year, a full year under COVID, and yet it has demonstrated resilience. So we'll start together as communities, and hopefully we'll be able to weather these. But in terms of loans, we, as a group, we had assessed loans not based on waves of COVID, but our own experience of studying health epidemics for the last 1,200 years. And we had projected on an average, it will take 2 to 3 years. And that is what we had factored. So businesses that required 3 years were given 3 years. Businesses that required 2 years moratorium were given 2 years. And so this, I would say, is more of an incident within our projection of a 3-year time horizon. And we expect that having factored that, there would be no distortions. We are confident that we had adequately accommodated all the clients who required to be accommodated, as our worst case scenario was 45%. We realized it's 32% who actually required the accommodation. We realized customers with 40 billion shillings of loans have normalized their repayments. We see the rest, 67% of the customers didn't require accommodation. So it is not a blanket accommodation. It's very, very specific. Consumer, salaried people who are still holding to their jobs don't require accommodation. Tea farmers, dairy farmers who are still in business didn't require accommodation. So our judgment is that the accommodation that we did up to 31st of March will be adequate and will not be doing any further accommodation. And the loans will be now classified based on their performance other than accommodation. But I will ask maybe Mary maybe to shed more light on reporting of the accommodation. Thank you.
Thanks, James. You've covered it quite well, actually, but our restructure framework and the methodology that we used to do this was very client-specific, industry-specific. There was no blanket form of accommodation that we did for our customers. And what that allowed us to do was to assess each and every customer and give them according to their need. For example, the agricultural sector was we determined would bounce back quite faster than any other sector. And as such, those were only given 6 to 12-month accommodations. We have been proven right, and a lot of those loans are now back on the books and performing very well. And then we have the real estate sector and the tourism sector that we rightfully said would take a longer period to recover, and give those from 13 months all the way on to 36 months, depending on the client. So we had a very client-specific approach that allowed us to not relook at this, and we would never want to be seen to be whitewashing the book and constantly restructuring, which could then be misconstrued as, going beyond a COVID issue. And therefore, we gave a very client-specific accommodation that allowed us to do it once and do it right. And therefore, we will not be relooking at any extensions. We will now then be doing a lot of relationship management, collaborations with our clients, acting a lot more as advisors, and making sure that they come back onto the books and onto repayment terms per their contractual terms.
Thank you very much, Mary. And I think that answer from Mary and myself answers George Belutza's question about the lockdown and the impact on restructured loan and the gains thereof. Let's go to a question by Kenya News Threads. Banking sector continues to evolve with the technology advancement. How will Equity leverage availability of 5G in Kenya, especially focus on new banking possibilities and detection of fraud? A very good question, and we are very excited about 5G because it brings very strong capabilities to our customers. And given that 87% of all the transactions that happened into the bank happened on mobile technology, it then means that that capability of those 87% transaction will be really, really enhanced. As it's known out there, Equity is very committed to gradually migrate to an enabled technology platform that it's open banking, that is interoperable. So we see this as a significant contribution. Equity is fully committed to big data. Equity is committed to analytics. Equity is committed to scoring. And we believe that the 5G will really enhance that capability. We celebrate 5G as one of the fourth industrial technologies to roll out significant scale in Kenya, and we hope that will go further in enablement. As a bank, we are adopting both the capabilities of big techs. We're adopting the capabilities of fintechs, and we are also adopting the capabilities of fintechs, such that it's the whole age, because we want to give the customers the freedom of choice, given that it's mainly on self-service platform. So we embrace, and we are confident that this will then put us in a better place. In terms of fraud detection, we just have enhanced the speed of internet and putting maybe the country on the highway of internet and the speed of 5G. And basically, it is the engines that creates the firewalls. It's the engines that are able to monitor online transactions that will help in terms of fraud management and detection. I think we go back to Lorna Gandhi. What is the estimated loan growth in real terms, i.e. excluding impact of FX and change in net present value due to loan restructuring? Mary, are you able to take that question now, or you want to go back to Lana?
I can take it.
Thank you.
Okay, so I hear you, Lorna. We do have an element of growth that is due to FX, and due to the restructuring we've done, there's an interest accumulation that is happening on the principal that is attributed there. That only attributes to 2%. So the real growth goes from 30% to 28%.
Thank you very much. For recap, on the grad SME funding schemes, where we have set $4.2 billion from our own, that is 450 billion shillings, the entire liquid balance sheet, and then complemented that with the 80 billion long-term funding from Team Europe and other development banks. What procedures will be involved in pre-qualifying eligible SMEs? That is from Oscar Magu. Over to you.
Thank you very much, James, and thank you, Oscar. We definitely have a war chest, which has been built through buffering our capital, as you have seen, and the protocols of releasing this to the market as follows. Number one is clearly all our credit officer will want to verify and validate your identity as a borrower. Who are you and what are you about and what is your business about? Then the second thing is what is your ability to be able to then service the limit and the limit of the loan that you're looking for. That is also a very important question to answer, and that's a conversation with your respective relationship manager, and in relationship manager will be able to bring that about. And then thirdly, perhaps most important, is defining the credentials you've got in terms of repayment of loans, your history of loan repayments, and nothing gives the history of loan repayments and your ability to repay better than cash flow. And that is why in the earlier conversation, we truly celebrate the fact that most customers have seen the need to use the bank as a home of savings, a home of transactions, and also the home of borrowing. Because when you give us your entire visibility of your transactions, then we are able to mark limits of lending to you without even you asking, so you'll find it available. And we're able to use your cash flow and data scoring. We've set up a credit scoring engine, and we now have a full department on automation and digitalization of our lending, primarily utilizing two channels. So we are matching the channel, we are taking the channel of mobile and the channel of online that is going on to the internet, and matching that especially to serve our consumer base, which is 95% of our customer universe, and our MSME base, which is both constitute close to 98% of our customer universe, so that the branch is then left to the advisory work of conversing really with large enterprises and corporate. In essence, I hope I've answered your questions around the protocols of that lending. I also want to assure you that from a management perspective and a board perspective, the appetites have been expanded, because as Dr. James Mwangi has announced, we've got a 35 billion shillings credit guarantee. Credit guarantee means we have found partners who are ready to work with us to share the risk of the micro, small, medium enterprise of this country. So we cannot wait, and we can hear that our commission is to actually go out and start the lending. And our branches will be open for that. Our mobile channels will be open for that. Our agency channel will be open for that. And our online channel will be open for that. Thank you very much.
Thank you very much, Polycarp. Lanak Gathia, there is your second question. What is the return on equity target for DLC subsidiary and the group for the financial year 2021? So Mary, you can take that, and also if you're able to take the NPLs for DLC, but Mary also could comment on that. Thank you, Wamai.
Thank you, and thank you for that question, Ronak. First of all, I may want to say that we are very excited about our prospects in the DLC. Because just like we said last year, when we talked to investors about the proposed acquisition, we saw three key things happening in that market. And the first one was, first of all, the prospects of getting to be able to bank the whole ecosystem or the segments. Remember, before we did the acquisition, we were very strong on SME banking, and of course, retail banking through our Equity Bank Congo. What BCDC gave us was the ability to capture the whole value chain, including the mining, and of course, the larger fast-moving consumer ecosystems. And that is what we have been able to achieve in the last half quarter of the year. And that is now going on after the merger was completed in December. Now, we also saw the possibility, and we actually got or achieved the possibility of a larger single obligor limit for the new bank, for the enhanced bank, for the merged bank. So customers are able to get larger loans. We are able to do the working capital that Polycarp very ably talked about, loans to our customers through the ecosystem kind of banking, and of course enhancing the consumer lending that we have already been doing in the past. With that, and also the prospects of the opened up borders, and we do appreciate that there are challenges that were arisen from COVID in terms of logistics, but we see the borders opening up with COVID now getting under control, and we hope that will happen soon. So we should be able to enhance the cross-border trading with our other existing subsidiaries. And this is not just in respect of DRC, but we are also talking about the other subsidiaries, the Uganda, we are talking about the borders with Rwanda, Kenya with Tanzania, Kenya with Uganda, etc., etc., and of course, Kenya with the DRC. So those are the three advantages and opportunities that we have seen post the merger in the DRC. If you look at the performance that we just announced for 2020, you will see that we have a huge opportunity, first of all, to optimize on the synergies that the merger has given us in terms of cost optimization. And this year we target to do quite a lot in terms of improving the cost to income ratio in that market. You will notice that this year, or last year that we have just announced, 2020, we closed at 79.2. We have prospects for drastically reducing that number to the group average. So that's one opportunity we are seeing. Of course, we are also looking at growing the revenues in terms of increasing the digital services, and that process has already been there. So what we are doing now is fast tracking the customers' use of digital services, etc., etc. So the prospects are very huge. Now, I will ask Mary to talk about the loan book assets and also the prospects that we are seeing for the loan book in DRC for this year. Thank you, Mary.
Thank you, Mary. On BCDC loan book, the book did change the group's mix slightly. The book is 50% personal lending or consumer lending, and then the remaining 50% is largely corporate. So you'll see the group's mix changed slightly in terms of our large enterprises has grown, and also our personal lending book has grown to about 26%. So that is the change in the mix that BCDC brought in. And in terms of asset quality, BCDC has a 9% NPL ratio, largely stemming from the corporate book, and the coverage is at about 65%. The reason for the lower coverage than group, which is at 89, is their book is more corporate, which means a lot more well secured, and the security of the lending in terms of the loan to value is very, very rich. As such, they did not need to take up additional provisions over and above what they already have. They also place greater emphasis on cash collateral. So that is cash that they're holding in Lee, and as such, they would not require as much provisions as, say, the rest of the group would. In terms of the prospects, the loan to asset ratio, I believe, for BCDC before our acquisition was at about 32%. And the group would like to grow that to towards 50%. There is massive opportunity in terms of the ecosystem that BCDC has historically banked for the last 100 years to deepen into the SMEs that serve that ecosystem. So they are very heavily in the corporate segments of mining and trade and such, but there's a very rich SME line that services those corporates. And Equity Group's strength sits in serving those SMEs. Therefore, that is where the opportunity lies, really reaching out to those SMEs as we strengthen the relationships that we have with these corporates. We will keep that going. There will be very strong relationship management around that, but also really deepening presence in funding SMEs to grow the DRC economy.
Thank you very much, Mele. And the last question we have is this is again from Rama. The central bank imposed limits on bank to mobile money transaction in 2020. Even if these caps were removed, will you revert to the pre-pandemic pricing levels, or will you maintain the lower transaction charges since 98% of the banks transactions are online? As maybe we observed earlier, the total cost of subsidizing the charges is about 4 billion shillings. That's really what we have subsidized this year. And if you look at that subsidy, if you added those subsidies to the performance of the bank, we could still have outperformed last year by about 2 billion shillings. We feel it's appropriate to use market mechanisms, or to use demand and supply. It's appropriate to use risk pricing as, and we are saying this because of the need for scalability and sustainability. So I think as a bank, we are strong believers in market-driven pricing. We are very strong believers in risk-based pricing, and we are strong believers in business models that are scalable and sustainable. So Lama, as we move the market, to guide us on the pricing mechanism. I want to take this opportunity to thank those who have given us those excellent questions. We hope we have done justice to them. But I want to invite my colleagues on the table, maybe for anything that may somebody feel they may have added more. Starting with Brent, if there is anything else you'd like to add.
Yeah, thanks, James. And maybe just to just bring together what my colleagues have said over the course of the last almost 2 hours, and just hearing from the questions where the concerns or the optimism is. If you look at 2020, and it's really to what James and Polycarp were speaking, it was a year of being relevant. And relevance for us came in terms of how we supported the communities. James talked about how we supported customers with the restructuring or the accommodation of loans, which where we stand today has reduced to 23% from the 32. The waiver of fees that we afforded customers. We're also relevant in the communities that we operated in. James highlighted the contributions of around 1.7 billion shillings together with our partners that we contributed. Relevance is also reflected in the increase in our market share, where it has increased from 10.6% in terms of asset market share to just around 12.3%. So customers, as Polycarp highlighted, have started to choose us. Relevance also is reflected in the DRC, where we are now number 2, and hopefully in the near term we'll be number 1. And to the earlier question from Ronak around where we see ROEs, in 2020 we reported an ROE of around 9%. As Mary highlighted, there is revenue optimism we have for that business. We highlighted that with the increase in the loan to assets, the margins should improve. But more importantly, this is a country that has very low credit penetration of around 6% to GDP. So here, it's really about growing the customer numbers from around the 800,000 to hopefully over the next 3 to 5 years, around 5 million customers. 2020 was also a year where our business model was really tested, and so too were a number of businesses globally. And here, in terms of the test, we reported a cost of risk of 6.1%. Yet we reported the least earnings contraction, even on an organic basis. Our funding franchise, as Polycarp mentioned, has increased. Customers have started to choose us, and we grew faster than the market at north of 30% organically. 19% organically and 31% if you include the purchase of BCDC. The model was also tested in terms of the quality of that growth. It's not just the level of growth that we look at, but it's also the quality of that, and that's reflected in our non-funded income contribution of 41%. And bear in mind, our non-funded income is well diversified, as James and the team has highlighted, across FX, across transactions. We were impacted by the waiver of fees, but despite that, our non-funded income grew 27%. It is also highlighted by the fact that our PBT before provisions grew 30%. And the contraction you saw was because we had a cost of risk of 6.1%, which translates to just under 27 billion shillings worth of cash provisions that we took. Our business model was also tested more so in terms of the social and economic engines that drive our business. And you can see how the two interacted with each other with what Polycarp and James have highlighted in terms of what we did for PPE manufacturing in the country, how the contributions we did in supporting the disbursement of PPEs and what it did for Kenya's ability to become a manufacturer of PPEs and reducing the cost of those. That truly reflects really the essence of the business model that we have of the social and economic engine that really interact together. And then lastly, 2021 and beyond is really about building back better. We talked about growth in the business. You saw the momentum in what the balance sheet grew by. And there's a lot of, if you look at the capacity looking into 2021, the capacity for us to stimulate the markets we're in. You can see this in the group liquidity ratio of just under 60%, in Kenya 73%. And just to reemphasize what that means in absolute terms, it means that in Kenya, we have 316 billion shillings worth of liquid assets that we can quickly redirect to the real economy. As a group, this is 464 billion shillings of liquid assets that we can redirect into the economies that we operate in. So those are maybe just some of the key considerations when you look through our presentation. And hopefully when you look through our presentation, we've given you a lot of disclosure, especially around the asset quality, the questions around the coverage across the various stages, or the qualification of a loan book is provided in the presentation that should be on our website. So hopefully that disclosure and the transparency also should give you some comfort in how we're managing the business. So thank you, James.
And maybe just to put color to what Brent has said, the nearly $500 billion liquid assets is 3% of the GDP, the aggregate GDP of all the economies we are operating in. So essentially that gives an impression of the firepower that the group has to pull through the Young Africa program works, and through SMEs by funding them and supporting them with capacity building. Maybe Polycarp, anything you'd like to add?
No, just to reassure investors in the entire market that they say customer loves you, no one will harm you. We will continue to do our very best to earn your trust. Earn your trust by remaining open for business across all channels, listen to you, accommodate you, and do our very best, of course, with the support of the entire infrastructure of the banking industry, to make sure that we walk with you. Because at the end of the day, to Brent's point, we all need to be challenged as a national ecosystem, as an industry, that it's only 26 people out of 100 who are being able to access credit in our country, while we have other geographies where you have almost 100% credit to GDP ratio. That tells us we've got a lot of work to do. We acknowledge it. And I think, as you've heard from Dr. James Mwangi, who's leading us from the front in building a capital base so that we can unleash this credit, which he calls oxygen, to the market. And we are very, very ready. And we thank you for continuing to trust us. Thank you.
Nitele, any other number you would like to put out?
Thank you. As Polycarp continues to lead us on the defensive side, like I said, the defensive side still remains strong. We still remain monitoring the accommodated book. We continue to look at the performing book as well to make sure it stays performing. We acknowledge the measures that have been announced by the government on Friday. And despite that, the worst measures were announced in 2020 and SMEs proved resilient. So we will continue to monitor them, to interact with them, to support them through this period, to make sure that they come out on the other side even stronger. So the defensive side will remain as strong, and we will work just as hard on maintaining the quality as we focus on growth.
Thank you, Ntela. Maybe parting shot.
Thank you, James. I think would like to say that last year we focused quite a lot and gave priority to communication and serious engagement with our stakeholders, our employees, the food soldiers, our shareholders, the regulators, our board. We are going to continue that because we do believe that that engagement has helped us in terms of being able to read the situation on the ground and right decisions based on the information available. We are going to continue to do that very aggressively also this year. We want to thank our board for being at our side and helping us ride through the tide, and they continue to support us in terms of providing the necessary oversight as we discharge our mandate as a management. Also to say that Our being a bit, especially among the regional subsidiaries, is really based on what we are seeing happening. If we look at Uganda, for instance, we are seeing a bouncing back of the private sector after the Q4, during the Q4 last year. The activity has really risen up. We are seeing very good prospects in terms of the ecosystem, and we are really focusing on that. The teams on the ground are really focused on that in terms of what can we do, what more can we do. We talked about the DRC, we talked about Tanzania and what we see happening in that market. For Rwanda, we are quite surprised to see that last year they had 172 new investment projects that are valued at about $1.2 billion US. That is money coming into the economy. And we do believe that that is going to help them to achieve the projected 6.3% growth in 2021. So that is the reason why we are upbeat, and we do believe and we can project that we shall be able to deliver a return on equity at the group level of between 22% to 27%. That is bouncing back from the 15.3% that we have just announced today for the year 2020, and a return on assets of between 3 to 4%, going up from the 2.3% that we actually achieved there last year. We want to thank you, investors and other stakeholders, for your support. Thank you.
Thank you, Mary and colleagues. I think for me, it's just to assure our host communities in all the countries that we operate, we'll continue with our efforts of enhancing our trust with you as communities. We'll continue with our shared prosperity model. To our customers, we'll stand with you, we'll work with you during this what we believe will be short time, and we'll cast our eyes on the long-term relationship that we have built with you. To our staff, we express our gratitude for you remaining faithful to the purpose and essence of Equity Bank and executing promptly to ensure that our agility is maintained. To the investors, as many have said, with a cash war chest of $500 billion shillings in liquid assets, we believe 2021 is the year to deploy that cash, get it sweating to create value. We believe that the coverage of 89% of our NPLs, through which we have cleaned up the accommodated book by the additional 9 billion shillings provision. We are well positioned now to focus on better performance from our interest earning assets. And as Mary has said, we believe 2021 will bounce back to be before or to pre-COVID years. And you can hold our hopes and trust on our past track record and on the strength of our governance structures, the strength of our brand, the strength of our execution capability, and our now new capability of scale, which brings in synergies of scale, economies of scale, and particularly with the adoption of online banking by our clients, we can promise better days ahead. Thank you very much for being with us.
Seeks to transform the lives and livelihoods of the people of Africa through programs activated through 6 pillars. These are the education and leadership development, enterprise development and financial inclusion, food and agriculture, energy and environment, health, and social protection. So far, EGF has equipped more than 33 million people with economic opportunities, skills, tools, and technologies to prepare them for the future. Education and leadership development initiatives break the cycle of poverty and develop the next generation of leaders through increased access to secondary and tertiary education, impacting 26,304 students to date. Notably, EGF's Wings to Fly program admits bright scholars from needy backgrounds to transit to secondary school. The program has an over 96% secondary school completion, with 82% of scholars attaining university entry grades. Another signature initiative, the Equity Leaders Program, connects top-performing secondary school graduates to leadership training, coaching, and mentoring prior to proceeding to university. The program has 13,775 university scholars, 633 of whom are attending or are alumni of leading universities across the world. Under the Enterprise Development and Financial Inclusion pillar, EGF stimulates job creation and economic growth by providing micro, small, and medium enterprises with advice and entrepreneurship training, and further improves financial capability and individual and household security by connecting people to expert financial education and access to financial services.
We are glad that our purpose distilled down to offering integrated financial services that socially and economically empower consumers, businesses, and communities have attracted the support of like-minded partners. I recognize the MasterCard Foundation for teaming with us to train 2.2 million bubbling young men and women to become entrepreneurs through a financial literacy program.
So far, 191,305 micro, small, and medium-sized business owners have been trained on entrepreneurship, with over 140,000 of the MSMEs have received 57.5 billion shillings under the Young Africa Works program, helping businesses to thrive. Through EGF's Food and Agriculture pillar, the program helps to create jobs, improve market access, and expand agricultural production by working in partnership with small and medium-sized farmers to increase their production capabilities and access technology and financial services. Under this pillar, 2 million small-scale farmers have transformed to farming as a business, while almost 40,000 small and medium-sized farmers have been supported to adopt modern methods of farming for increased yields. The focus of the Energy and Environment pillar is the conservation and smart use of natural resources by expanding forest cover, improving water security, and promoting the use of renewable energy and energy-efficient technologies. The pillar has impacted 780,000 households and businesses to access clean energy products, including solar panels for lighting and heating in homes, schools, and hotels. The pillar has encouraged installation of biodigesters for biogas for cooking and generating electricity to power on-farm activities. More than 240,000 households have embraced clean energy products, while 3.12 million trees have been planted to increase forest cover and conserve the environment. The health pillar provides access to comprehensive health financing and private sector-led, affordable, high-quality, and standardized health services. So far, 33 Equity Afya franchise-owned medical clinics are operating in Kenya with more than 305,560 cumulative patient visits. Under the social protections pillar, EGF has committed to reduce social and economic risk and vulnerability and alleviate extreme poverty and deprivation through cash transfers. It provides thousands of marginalized and vulnerable households living in Kenya, Uganda, Rwanda, and South Sudan with social payments through cash transfers. The foundation is involved in 22 programs across East and Central Africa, serving 3.3 million persons. So far, 77.4 billion shillings has been disbursed via equity cash transfer infrastructure. This is but a glimpse of the activities of EGF in our pursuit of championing the socio-economic prosperity of the African people. We invite you to learn more and join us.